Thank you for joining us today. Our viewers have been waiting for watching this interview because they're a lot of big, huge fan of PIMCO, and you're one of the members there, right? So
Yes.
please say hello to our viewers.
Hi there.
That's it?
That's it.
So let's talk about the PIMCO first. So could you explain the current investment scale and portfolio by asset class? Like, what is the proportion of the bonds against equities or alternative assets?
Yeah, so right now when we look at bonds around the world, they seem to be reasonably fairly valued across the board, which means our positioning is probably going to be neutral in bonds in general, interest rates. In terms of equities, we have a slight bias to be a little bit long equities right now, just given where we are in the cycle. But where we do actually see a lot of value is in credit markets, especially emerging market corporate credits.
Mm-hmm. So, PIMCO is one of the top companies in bond market, right? So a lot of people pay attention to your strategy. So what is your strategy that has emphasized this year? Did you focus more on developed economies or emerging economies? And what was the most lucrative asset class, region or country?
Yeah, that's a really good question. So this year has been, there have been some surprises this year for sure. One of the biggest surprises is that interest rates have fallen a lot faster and a lot harder this year than we anticipated. And also some of the emerging market countries have been a surprise, like Russia has really unraveled quite quickly this year. We've been reasonably disappointed with the performance of Brazilian asset markets. So this year has been a pretty tough year in asset markets, and liquidity has been tough, and we've seen a big move in the yen. We've caught quite a lot of that move in the yen. But we haven't caught all of the move in interest rates. But we're kind of now neutral on interest rates in terms of duration positioning, so we've done okay. But in terms of where we think the opportunities lie going forward, I think what we're going to find is there'll be a lot of differentiation across markets. We see it across the globe in terms of where, for places like for Brazil, for Mexico, for China, I think there'll be a lot of opportunities across the board because things have got cheaper in emerging markets in particular.
Okay. So, contrary to the market's expectation that great rotation would take place, but it seems reverse rotation was more prominent. Mm-hmm. So, what is PIMCO's prospect on capital market, and which would continue between the reverse and great rotation? Yeah,
so part of that question probably goes back to the first point in terms of us being reasonably neutral on duration right now. So we don't necessarily think that bonds are going to outperform significantly from here. And as rates go up in the US over the next few years, I think there'll be a bit of an issue for investors to deal with. But in terms of the great rotation not happening, it boils down to the fact that growth has been disappointing around the world, very disappointing. Mm-hmm. It also points to the fact that we're seeing deflationary forces, particularly in Europe, and we've seen PPI prices going down significantly around the world. So these things have driven investors to buy bonds. They want more security, they want a bit of income, but more security, and they've bought bonds. But equities as well have done reasonably well, partly because companies are buying back their own stock. We don't think that's going to stop anytime soon. So we expect investors to keep hold of equities because of the good technicals that are there. But for bond investors, I think it's going to be a bit of a challenge going forward, and I think they have to be a lot more careful.
Uh-huh. So let's move on to the topic. Let's talk about the global economy. Like most countries are facing global economic crisis. So I wonder your house's view on this. What is your house's view on global economy, especially three countries like the US, China, and the Eurozone?
Our view is that naturally it's going to drift down over the next few years to a slower growth rate, probably closer to 6. But really the place we're most worried about is Europe. The growth rates there are negligible. The policy framework is really struggling at the moment to deal with the deflationary problems and no growth. And really the places where we are seeing growth is really emerging Asia. So at the moment the world is looking reasonably unbalanced.
Okay, but what about the Japan? Like a lot of analysts and economists expect that their GDP will recover in the third term, but their GDP was minus 1.6 or something.
Yeah. That was very surprising. People were expecting a good number. Clearly, the sales tax had a big impact, and people brought their consumption forward, then it went down, and now the sales tax is probably going to be off the table, at least the next round of increases, and we're waiting to see how the markets respond to all this stimulus. It's doubtful that you get another big negative print next time round, but clearly the challenges for the Japanese economy, at least from a policy standpoint, are to convince locals that it's a good time to start spending and that inflation is going up and that this new program is going to work. This is extraordinary monetary stimulus, and it should help lift asset markets, but we're yet to see it feed through to the economy, and we were disappointed just like everyone else on the growth number.
Okay, so there are a lot of uncertainties in the global market, but can you tell us just 2 or 3 big risks that we should be cautious of in the global market?
Yeah, I think that the first one is liquidity. I think when you scratch under the surface of markets, it's actually quite hard to trade in secondary markets, especially in the credit markets and some of the peripheral bond markets or even emerging markets. So I think liquidity has been very abundant, especially dollar liquidity for the last 4 or 5 years. And with the Fed ending its QE program, you're not going to get that many dollars around. So the liquidity may shift to other currencies. That's the first thing to worry about. The second thing is just growth expectations in general. It's looking increasingly likely that 2014 will be quite a disappointing year overall. And going into 2015, it doesn't look like there are going to be a lot of growth drivers for next year. So I think one of the bigger risks to look to is, where do people think growth expectations are going to be, and what's going to push people back into spending, getting governments back into spending and getting investment up again. So that doesn't look too great. And I think the third big issue is really currency and currency moves. We've seen an extraordinary move in the yen. We think that the euro may go down as well if the ECB does its next round of QE, which puts a lot of pressure on other currencies. That risk will translate to other currencies, and then we might see a policy response. So that's a big risk over the next 6 to 12 months.
But is there any possibility to recover all the worst situation in 2015?
Well, it's interesting because 2013 was such a good year, with equities being up over 30%. This year was very difficult to replicate that kind of performance, and I think everyone has begun to ratchet down their expectations. So I think 2015 may be more about income than capital appreciation and what we term in bond markets carry, and being careful on picking winners and losers for next year. So it's very hard to see next year being a brilliant year in asset markets. We'll see. I'm not that convinced.
Okay, so when does your house see the Federal Reserve starting to raise the federal funds rate, and what is your strategy of a bond portfolio to this change? Yeah,
so we think they go next year. The view right now is probably in the summer. But if market conditions deteriorate, if growth outlook deteriorates, they're going to stay flexible. They could push it to September. But obviously, with them coming off QE, the next natural step is to try and raise rates, to normalize rates. But at such a low level, 25 basis point hike may be nothing more than a bit of a tiny signal. The question is, do they get the opportunity to raise rates up to 1%, 1.5%, 2% over a 2 or 3 year period? And at the end of the day, we don't think they're going to raise rates beyond 2%. We think 2% is their kind of neutral rate. In terms of opportunities, it just means that the far end of the curve might come under a bit of pressure. So bonds north of 5, 10 years won't possibly perform as well as the bonds at the front end of the curve. But still, as things stand, the US right now is still a very attractive overall fixed income market.
So IMF picked South Korea as one of the most vulnerable countries once Fed starts to raise the interest rate. So what influence would the interest rate have on Korean economy?
Yeah, I think the IMF may have been a little bit unfair. I think to point out one country saying it's the most vulnerable. Look, Korea cut rates in August. And October.
You're right.
And
you know that.
Yeah. So and our bias is probably for them to be able to cut more going into next year if they need to. I think that the fall in the oil price that's happened, if that ends up being a bit more permanent than temporary, then that'll help as well. And a big move like that could be worth 25 basis points of cuts anyway. I think in general terms, like I said, if the US raises rates by 25 basis points, it's not that big a deal. If they get to 1%, 1.5% or 2%, that's when the bigger pressures will come. But I think Korea has done really well. The growth rates are reasonable, inflation's contained. I think obviously what the Koreans are looking to a currency and seeing what other currencies are going to do, whether they can remain competitive. I think that's where the pressures are. I wouldn't worry too much about what the IMF has said.
Okay, so Korean market has expected a lot, the investments from PIMCO, but it is recognized that PIMCO's direct investment to the South Korea Treasury bond, KTB is not that very active. So could you tell us whether there's any particular reason that holds back the investment?
Well, we are invested in the local market. We have significant allocations across our dedicated portfolios. I think for the main driver for us is value. And if we find yield in other parts of the world or real interest rates that are more attractive, we'll be more active there. But two things stand out for me with regard to the Korean market. The first one, obviously, is withholding tax and capital gains. And the second one is the need to use a local custodian to trade the currency. If we could relax those things, I think it may make the market more attractive.
Okay. So we will talk about Korea. So unlike your saying, Korea is quite doing well, but because of the recession, the Bank of Korea, as you said, cut the policy rate 25 BP each in August and October, which led to bringing down the market rate as well. And it is expected that bond investment return will shrink too. So under these circumstances, KTB is still attractive to the investors?
Well, certainly, I think for foreign investors, I think they can find high yields elsewhere, and maybe allocating to Korea as a part of a more diversified strategy makes sense. But if clearly there's a view that the central bank can cut rates more, there may be another increment. You may see more demand because of that. But I think the market right now is waiting to see whether the oil price does that cut for them. That'll be a handy benefit. But right now, I don't think it's offering extraordinary value as an asset class right now. But I think the equity market is more interesting, and then there are lots of credits that we like. So there's other things that we can do here.
Okay, so if you were investor, then would you put some money into Korea market?
Well, certainly for long-term investments in things like in equities for sure, and we're always on the lookout for fixed income opportunities in credit markets. I mean, the good news is that the credit market here is extraordinarily well developed, and there are lots of credits. The bad news is they're all reasonably rich, so we need to find some cheaper securities. But I think longer term, I think the horizon is very bright for Korean asset markets.
Okay, so this is going to be the last question, and I know it is a little bit hard for you to answer my question, but after Mr. Bill Gross left PIMCO, a lot of news came out that the major funds saw outflow and the competing funds are benefiting the change. So how is the situation at the moment? Yeah,
it's really good actually. I think we have a new leadership structure. We have a new group CIO, Dan Iverson, and we have a layer of CIOs that work with him around the firm. A very, very experienced team, very well diversified team. So things feel good. The really good news is that obviously there was a bit of noise around the announcement, and we had some outflows at the time. But all of that's stabilized, and we're back to looking at investment opportunities and looking forward to our next forum, which is in September, to talk about strategy. And things feel really, really good. I'm really happy with the leadership structure and the team, and I'm quite excited about the opportunity. And as a part of that, I'm very excited to be coming to Asia myself to run portfolio management. And I think the future looks very, very bright.
Thank you so much.
Thank you very much.
It's a pleasure to speak with you. It's Luke Spajic from PIMCO.
Great.
And I hope you have a wonderful time in Korea.
Great. Thank you very much indeed.
Thank you so much.
Thank you.